Time to hear from a property investor who has a $30 million property portfolio, who built it from absolutely zero with no inheritance or anything like that. And he didn't do this 50 years ago. This guy is absolutely ridiculous. Now, he's not trying to show off. He's definitely not a flashy kind of guy, but he did just buy a $1.2 million Lamborghini Revolto. Why? Because he loves cars, because he knows that that's what's going to get him there. He's going to get his property, he's going to get his car dream by building a portfolio of properties, and that's what's been driving him. Hey everyone, my name is Joe Tucker, and together with Jeff Miles, we created Oz Property Investors, which has over 80,000 members in it, and they're all learning, they're all growing as property investors of how do I get a better portfolio. And each week we interview top property experts, people who have done the thing that we want to do, and then we just sit down and ask all the questions that we want to ask. We ask the smart questions, we ask the dumb questions, and we try and unpack the lessons so we don't have to make the same mistakes that this guy has done. He made a $250,000 property mistake early on in his property's journey, but he still got over it. Big key takeaway that I took out from this session alone was always take action. Right now, you probably have borrowing capacity, you probably have serviceability, and you probably have some equity in your portfolio. Why aren't you using it? I'm going to go have a chat to a broker right after this conversation to maximize my portfolio. Let's jump into the session because you're going to get some value out of it. Let's rock and roll.
And we are live on Oz Property Investors. We bring the big names and we have the big fun. The internet is super fast these days, and the cars are even faster this session. I've already mentioned it. I'm sorry. But no, big session, everybody. And we're going to talk about those little known about the $30 million property portfolios. First off, we're going to talk to the fundamentals. So the things that you need to understand before even going down the path of multi-million-dollar portfolios. Then it'll be, okay, great. What are the strategies? How should you start? What mistakes are you making? How to get unstuck in the portfolio? Because it'll happen to most of us along the way. What does that look like for Richard? And we'll finish off with the advanced techniques that very few multi-million-dollar property investors are sharing. So stay tuned for that, because Richard is also a broker. So if I haven't pumped that enough, Richard, how are you going?
Yeah, good. Thanks for having me on, guys.
You're welcome. Thanks for coming back. It's been a year.
Welcome back.
April 2024 it was when we last had you.
Is that right? Yeah, it doesn't feel like that long at all. Time flies when you're having fun, they say.
I know, writing plenty of loans and making plenty of deals. Joe, how you going, man? What's happening?
I'm very good, mate. I'm very good. It was called Lending Overdrive, shifting gears for the next phase of growth, Richard Morgan. So go back on YouTube and watch that sucker. We're not going to talk about the same stuff that we talked about back then. I think we were quite heavy in the development talk and lending situation, but we wanted to get you back on and talk about the foundations and how this all kind of came about. Like, one of the questions that we like, if you're in the comments on the little chat bot and in the Facebook or the YouTube, and you hear, oh, this guy's got $30 million, and your first thought is, oh, great, he got an inheritance, or great, he got a nice little hand up in life. Rich, what would you say to that? How much did you get as an inheritance to start your property portfolio and kick this whole thing off for 0 to 30 million?
Yeah, still waiting on that one, Joe, to be honest.
No lotto wins.
No, not yet. But my dad did win one lotto when he was 19 years old, and that was well back in the day. So you can imagine what happened with that lotto win when he was 19 years old. All that money is gone. He didn't buy any investment properties. Well, actually, he did buy one, but it didn't work out that well for him. So, I did learn a lot of money lessons when I was a kid. And, we're in a middle-aged family, middle-class family, and just a normal sort of family living in the outskirts of the north of Sydney. So there was no sort of free kicks in that part of the world then. I saw my parents struggle day to day, week to week with money. It was probably a big sort of thing. It caused a bit of a rift in their relationship over a long period of time. And I think that sort of hardwired something in me to go, you know what, I don't want to be that guy. I want to be in a position where money isn't a problem.
Yeah, that's it's interesting, that kind of drive, because everybody's drive is different. Like, some people are trying to get away from something and some people are trying to go towards something. So I feel like for you, maybe you eventually shifted across towards a supercar. Do you call them supercars? Like, I don't know what they are. I don't frequent Ferraris, or Lambos, or whatever kids are driving these days. But no, so whereas initially you were like, okay, I need to get out of this paying money doesn't need to be a problem for me. And that was some of the motivation. And you sort of discovered some of the toys later in life. So I wanted to, because there's so much to unpack here about your scenario and your situation, which we spoke about, as Joe said, in the investor story. But the first thing I wanted to know is what are the investing concepts that people need to know about before you even sort of get the really exciting stuff? So, I mean, this is exciting stuff, but like compound growth, inflation, what are those things?
Well,
Well,
I just wanted to frame this conversation just a little bit more, because the thing is, guys, you're listening to a guy that started from zero and has created a $30 million property portfolio. He just bought a $1.2 million Lamborghini Revolto because that is his dream car, and he can afford to do that kind of stuff. So there's so many. You are the 0.00001%. So thank you very much for taking the time and sitting down with us to have this conversation. But two, guys, you can learn so much from here. So jump in the comments if you have any questions. We had a question post, which we'll get to as well. But there's so much wisdom to unpack here, Rich. But yeah, sorry, I just wanted to jump in and just pre-frame that. Like, holy shit, $30 million. Congratulations on making that happen, and all of the hard work that you got to get, you had to put in to get it there. But sorry, what was your question, Jeff? I feel like I'm just excited, guys. Sorry.
Okay. The investing concepts like inflation, like compound growth, it was, whether somebody's got a $30 million portfolio, whether they've got a $300K portfolio, I think everybody has a lot to share. So, but go on, Richard. Congratulations.
Is it important?
I mean, is it important? I don't know. Really, at this stage, it's just a number, right? So, sort of grew up with aspirations of, being retired early and having an SS Commodore in the driveway of my house in Hornsby Heights. That's all I wanted when I was a kid. I had a picture of a Lamborghini Diablo on the wall when I was a kid, and that was kind of like, wow.
Is that the blue one?
Sort of dreaming. I think it was purple, actually. Like I think they call it the SE 30th anniversary purple or something like that. But anyway, I'm going down a rabbit hole here where we're going to talk about cars. I guess the sort of point there was that those aspirational things in my life weren't really something that I was chasing. It was more just that concept of financial freedom, and sitting there as a kid watching my parents fight about money all the time, sort of like the basis where I put myself into research mode and went, okay, well, I know I want to be financially independent. How do I do that? What do I do? And, you come across books, right? Really basic books that to start with. And, I wouldn't even be able to give you names of what they were, but basically introducing the concepts of compound interest. That was probably the biggest penny drop moment I had. And that's where I started to, okay, well, I need to accumulate capital and you accumulate money and grow that money over time. And if I can do that in a way where I'm getting compound growth, then, that money is going to work harder for me at some point than me working for money. And so, I was 16 years old or whatever it was when I came across this concept and, sort of went, okay, well, what can I invest in over and above that? And it's like, okay, there's always shares and managed funds and stuff like that. But the concept of property always stood out to me. And I think I just liked it when I was a kid. I think I just liked the idea of property because, it's something tangible. It's an asset that you can look, see, feel, touch. It's real. Whereas you put your money near the stock market, got no idea what's going to happen with it. And so, the thought of investing in property and then using that to generate compound growth was kind of like where I started. And then you start to unpack things more and more as time goes on, right? And you read more books, you read things like Rich Dad, Poor Dad. You start to think about mindset and going, okay, well, really opening my mind here to the possibility of doing things differently and of more, right? You start thinking about this is such a plentiful amount of resources out there in the world in terms of things that you can learn from, things that you can do. There's really no limits on what your potential is outside of the limits that you put on yourself. And so, I'm sort of arming myself with this information, this sort of building this mindset at an early age, and then, wanting to do something in property at, 16 years old or 17 years old. So growing up and working where I can, try and earn some money while I'm at school, and go through uni, earning money while I'm at uni, full-time uni, full-time work at the same time. Just building everything I can in terms of that little pot of money that I've got to try and just try and get a head start, right? So like you say, Joe, there's no sort of free kick at the start of this journey. So I think at one stage, I think I was working 3 jobs while I was at uni and doing full-time study at uni. So it was pretty hectic, but, I was just driven by that purpose of, I can do something with my life here if I can build a big enough stash to invest, and, that'll get me to early retirement and all that sort of stuff that comes with it. But I think there was a couple of books there that sort of unpacked the move into property, which was, if there's a few people who have been around as long as I have, they might remember these books. One was Wealth Magic by Peter Spann.
Peter Spann, yeah. I mean, I've heard the name, but I don't think I've read the book. So, yeah, Peter Spann.
Yeah, I haven't read that book.
Infamous.
I mean, there's him. He's no longer with us. He kind of went down a bit of a rabbit hole later in his career. And obviously, Robert Kiyosaki, if you've seen any recent stuff on YouTube, probably don't watch it. So they're in different positions to where they were when they wrote those books. Look, I think I've even got some Donald Trump books there, to be honest with you. He did a collaboration with Robert Kiyosaki. There were all these sort of books. They were all at the same sort of time. And the other one in the property world was Steve McKnight, 0 to 130 Properties or whatever it was called. Those sort of Peter Spann and the Steve McKnight books really sort of cemented, okay, property, it takes things to the next level because it creates leverage. Using other people's money to generate, growth, capital gain, whatever it is, a yield, which you couldn't achieve if you're doing on your own. And that was kind of like the basis for me to go, I understand the principles here. And, over and above all of this, I'm with that sort of mindset, reading that I'd done. It was kind of like, well, it's good to learn a theory, but you really need to have a crack and put it into practice.
Yeah, it's a crazy thing. This whole when I was starting out, I was like saving and I was investing in shares, and I was just had a little savings account, and I might have been getting 5% interest at the time. And I'm like, great, let's just say I had $100,000. Great, I've got 5% of that. Great, okay. And then that doesn't really move the needle. It doesn't really move the needle too much. I didn't even have 100,000. I think I had 50,000. And then you're like, but wait, you can buy a property with your $100,000 or your $50,000. Back then you could not. You probably can't buy it with $50,000 anymore. And then I can own an asset that's $500,000 that's now growing. So at 5% growth. So I've now 5x my return with the same amount of capital. What the hell is this thing? And how does it actually work? Like, even if you are slightly negatively geared, which everyone is that's getting into the market right now at a 6.5% interest rate, it still makes sense if you're buying in a growing market that's moving. And that was a real light bulb moment for me. I don't want to skip ahead into the journey of how you got too far, but I do. What are some of the mindset stuff that took you to the next level for yourself? Because a lot of people can go to 1 million. A lot of people can go to 5 million. I know a lot of people have gotten to 10 million in property portfolios. But was there any recent resource that kind of shifted you to go from the lower end to 30 million? Like, was there a resource that got you there?
I just realized, I'm sorry, Richard, I haven't introduced you, and it's very rude of me, because people are asking, well, who is Richard? What is he? And we know you've done a $30 million property portfolio. But you, off the back of 2 decades investing in property, so settle into some people's questions, you've been able to leave your corporate career, and probably about 7 or 8 years ago now, you started Freedom Funding. Was it 7 or 8, or was it 10 now?
Yeah, 2017, 8 years ago.
So you're in broking. You're in the broking game. You love off the back of your results in investing. You've got renovating, developing. You've be able to provide grounded experience to build your own portfolio of 30 million. And you also, as Joe said, you love Ferraris and own a couple of them. So you get out in those regularly. So back to that question about the resources. Like, how did you sort of step up to those sort of deals? That was the crux of the question, was it, Joe?
Well, yeah, just more of the mindset, because I don't want to miss the journey along the way. But this part of like, because everyone's read Steve McKnight, everyone's read Rich Dad Poor Dad, and if you haven't, I haven't, like literally, I'm just looking on Amazon now to go ahead and buy Wealth Magic, to see what that's all about. And it's just a dude standing in front of a Ferrari, which is perfect. If I zoom in, Rich, it kind of looks like you. But yeah, was there anything like book wise or resource wise that took you from that next level?
There wasn't really, to be honest. It was more just understanding, those concepts at a basic level, and then getting into execution mode as quickly as possible. And I think it was I'm one of those guys that learns a lot when he does something. So, you can read a textbook a million times, but it kind of doesn't really mean anything until you get out there and you do whatever it is, right? And so I think and I'm very, very results driven, right? So I always want to be doing things that drives a result or, influences an outcome. So getting out and then, seeing proof of concept after you start buying and holding property, you see it go up in value, you release equity, you buy another one, all these sort of things, you just get in the zone, right? And you go, okay, well, I need to keep doing this because it's working. And every time you do something, every time you buy a new property or you do a reno or a project or whatever, you'll learn more. And so you just keep sort of refining and revising the way you do things, so that you can do them better for next time, make better choices next time. So was just continuing to execute over a long period of time, right? I mean, there's a couple of things I'll touch on in a second, which I guess was sort of pivotal to it all. But I guess that the pivot point where things accelerated would have been when we went from passive buy and hold to active development. And I think that was the acceleration strategy. And there's probably a really important thing to note with that, though, is that if we hadn't have been in the position that we were, as a result of a successful buy and hold strategy over a long period of time, we wouldn't have been able to do that. I think a lot of people hear things about property development and they see things about property development. People got numbers all over Instagram and whatever else. But it's not that easy to just jump in and do that. And I've got a story to share around what happens when you do jump in too early and think you can do property development without being adequately prepared for that.
Yeah, it's crazy because, back in the day, there were all these courses and things and books and stuff, and you can get just analysis paralysis and stopping you from, like, you get so educated, you get overly educated, and then you're like, oh, I still don't know enough, I'm not going to take action. And then it's already been 6 months, 12 months, a year, and you haven't actually bought a property. It's like, so there is a fine balance of getting educated and making it happen. Okay, well, let's go. What does it look like? What did the first purchase look like? What was how did you get into that? What were your thoughts around that? Would you, give us a run through of the first one or the first couple.
Yeah, cool. So I won't go through everything because we will take a long time, but I'll try and hit the sort of key points of the journey. So I suppose I started off my investing, with what little I could generate, while I was working. And, I rolled that money into a managed fund when I was, 18 or whatever. And then I was growing that whilst at uni with the compound interest, calculator there at night, every night before I went to bed. And then just before the end of finishing uni, I met my then wife, Melissa. So
she's been on the show as well. She's a powerhouse property manager. Yeah. So she thinks the same way that I do around investing and life in general. So I think this is where also a lot of people get quite stuck, is they don't have the right partner when it comes to the investment journey, or they can't communicate effectively with their partner around what they're looking to achieve and how they could work together on that. Is see it all the time, unfortunately. Now, fortunately for me,
she was, violently aligned to exactly what I wanted in life, and extremely action orientated. So she started earlier than I did. She bought her first at 18. And it took me a few years after that to get my ass into gear.
Were you together at that time when she was?
We weren't.
No.
So when I met her, she'd already had that. She already actually bought and sold that and bought another one. So not long after I met her, she bought investment property number 2 up in Queensland. And so here I am going, I've got this great strategy. I'm going to go and make all this stuff happen.
And show me the receipt. Where's your action?
Yeah, exactly. And I'm like, damn. Like, I just need a little bit more capital to get into something. And so instead of, pulling together that capital, I mean, it's really hard when you start from zero, right? I mean, you don't have any money, you're not earning a great amount of income. Even though I'm working full time in a Good Guys store selling toasters. I went from that, finished my degree, and got a full-time job in a graduate program, and took a even bigger pay cut to go and start that career. So it was like, I don't feel like I'm making great progress here. But instead of taking that money from the managed fund, we actually started importing cars from Japan. And we're making a little bit of margin on anyone that the car person, like Nissan Skylines and stuff like that from Japan. You can buy them at the auctions, bring them over here. Given that, yeah. So I mean, we did that. We did a few sort of flips with cars there and made a little bit of money. And I'm like, great, this is like a capital acceleration thing here. I can get myself to that deposit. But then there was kind of like
Did you keep one? Like, I mean, you're importing these incredible cars and you're like, well, if I import 12 of them, I get a free one. Import 12, get one free. Is that like how you were thinking, or?
Yeah, well, we just didn't have enough capital to do that, right? So it was one at a time. Eventually, like Mel said, I don't want to do it anymore, which is pretty sensible. And I imported the car that I really always wanted, which was an R32 GTR Skyline. There was a certain rule that was coming out where you could import one of these things, and I'm looking at it going, geez, I can make 10 grand on a single car, and that's enough to get me there. But anyway, I got the car in, played around with it, had great fun, blew the engine up, ran out of money maintaining it and keeping it on the road. And this was a process of a couple of years where I sort of just turned my brain off and forgot everything I learned in those books. And by the end of those 2 years, all I had was a car that I had invested all the money I had into it. I actually got a relocation with work from Sydney down to Melbourne. And that was kind of the kick in the ass that I needed to go, what are you doing? Sell a car, take that, the money you got from the car, which was, I think it was like 25 grand or something back in the day. The Victorian first home buyers grant at the time, I think it was 10 grand. And then whatever funds I had left over. And that was the deposit for my first purchase, which was just a 2-bed unit in Richmond in Victoria, which I've still got today. That cost me about $229K back in the day. Finally got my ass into the market. I think it was about 2006 with the first one.
I think that probably would be worth about maybe 500, 550 now. Are we talking 600?
Yeah, it's probably.
Yeah. No. The Richmond unit, yeah.
The car's gone, thankfully. But yeah, look, the car would probably be worth 100K. So, but anyway, like that. I know guys that have still held on to cars from the era back then, and it's wonderful that they've gone up in value so much. But that apartment going from 229K to 500K is a far more superior return, better structure in terms of investment debt. I've leveraged the equity in that property to use it to go and buy more investment properties. So it's a huge sliding doors moment to actually get rid of the car and get my ass into gear. And look, I think you learn things, right? I mean, that was a great little apartment because it was an owner rock. I lived in there while I was down there, and then eventually moved back up to Sydney. I think it was just a sort of 6 months and a week after I'd lived in it. And I remember that because I got audited by the Office of State Revenue down there after I moved back because they didn't believe I was living in it. Make sure you keep good records when you're a first home buyer. But yeah, you kind of look at it and go, well, geez, I should have bought a house in southeast Melbourne. That would have far outperformed it. But look, the reality was, It didn't really suit me at the time in terms of what I was looking to do, where I wanted to be. But, I really wanted to focus on something that I could afford rather than trying to stretch myself for that very first purchase. And not long after I moved back up, I think it was about a year after I'd refinanced it. I think with the val came back at about 320. So all I did was sort of like a lick of paint and some carpets, and left some furniture in it. It was renting out for about $330 a week, so it was a pretty good little return for the first one, and that sort of stepping stone into the market that was able to sort of springboard me into the next one.
Thanks for sharing that. I'm going to hijack some of this because I think there's so much value. Like, yes, we could take a run through the properties and we could learn a whole bunch about the properties you own. And somebody's asked how many you do currently have. So if we don't want to talk about that, just give me 4 blinks and people won't people listen to the podcast. But no, so I just get to watch you blink. What I want to know is, like, so you bought a unit starting off. How would you, if you were fast forward 20 years or 19 years from 2006, what are you sort of seeing that where should people, the lessons you've learned, how should people start or look to start today? What questions should they be asking themselves? Is it budget-based or is it strategy-based? How do we kickstart our $30 million property portfolio today if that's someone's goal?
Yeah, great question. So I guess, I mean, it's very broad, right? So
Too broad.
To build a $30 million portfolio, like it is going to be different, right? And, if you want to be in the top 1% of property investors, then you're going to need to be in the top 1% of, income earners. That's the reality. And so when I was building, or when we were building our portfolio, the environment was different in terms of finance, right? And I think, it's as restrictive as it's ever been in terms of finance right now, with a 3% buffer and, all that kind of stuff that I got overlaid and has evolved a little bit since about 2016. But back then it was a lot easier to borrow money. And also don't forget, 15 years ago or 20 years ago, almost, asset prices have moved a lot. So, that 229K property being worth, call it 550 now, that's more than 2 times. So if we were able to build a passive portfolio back in the day, I think we got to a peak of 15 properties. And today we've only got 8 or 9. I actually don't know how many properties we've got, which is pretty bad. But we've rationalized some of the low performers. We've gone in and out of some assets. But to have 15 properties that we had in our accumulation phase back 10 years ago or 15 years ago, that's a lot less in today's money. So that might only be 6 or 7 properties in today's money because of the value of property moving over time. So I think that's probably a key thing when people are looking at headlines going, how do all these people get 15 properties? Well, yeah, they did because they were a lot lower value back then. And yeah, the finance environment was different. So, if you've got yourself to 6 properties today, then in this finance climate, then you're doing something really well. So don't beat yourself too much over, those sort of numbers.
So if you would you be able to do what you did? Okay, so let's just take the same Richard brain that remains, and then starting from kind of zero, and you're, I don't know, 25, would you be able to get, to where you are now, same kind of position in the current environment as it lays, as it stands?
You can still do it, but it needs to look different. So, in order to, if you have a vision to go, I want to build a portfolio of 15 properties, then you can do it. But you're still going to need to go and find a way to earn a ton of income. But you're most probably going to need to go down, say, the strategy we're using trusts. That's not a strategy for everybody. And, I know a lot of people will jump on Instagram and say, just do the trusts. And, next thing you know, you're a multimillionaire. I can tell you that, if you haven't been through that process before and you haven't actually seen the nuts and bolts of it, it is very difficult to successfully execute that strategy. There's a lot of pitfalls and a lot of things that can go wrong. And at the end of the day, all you are really doing with a strategy like that is you're deferring the issues. So when I was building the portfolio, you would run out of one of 2 things. You still had serviceability issues, right? It was just a lot easier to borrow more. So I would run out of borrowing capacity or I'd run out of capital. So I'd always be looking to harvest equity out of the investment properties where we could. So, frequently doing valuations with multiple lenders and all that sort of thing. And then quite often there would be equity there, but you wouldn't be able to access it because serviceability wasn't there. Now, the thing I had to do, was really sort of focus on what I could do to generate more income. So a lot of the time, I invested a lot of time in my career back in the day when I had a PAYG role. And, I really tried to push myself to the sort of highest possible levels of each of the organizations I was working in. At times, it meant I was jumping from one organization to another for money. So if I got a 30 or 40K pay increase, maybe it was going to be a career limiting move in terms of moving sideways from one organization to the other. But if it meant I could buy one or two more properties off the back of that, then, I was going for it. So, it was.
That's such a dedication to the cause. Like, why are we working anyway? Right? 98% of people are not doing a job that they particularly love, and they're not doing it. Like, if you're a teacher or something like that, you're doing something pretty cool. You're helping, people grow and do that kind of stuff. Great. It makes sense. But why do you show up to an office and work for somebody else and earn this rubbish salary? Why not? Someone's offering $100,000 for you now. You can then go to company number B and get $140,000. And people just don't make that leap because they're like, well, I don't, they don't have the goals of, well, the reason why is because that borrowing capacity needs to be there. When similar story to me, like, I was jumping not job to job, but like always on the lookout for a new role, for a new salary, and then building upon and building upon and building upon. And like, to the point where I was offered a small salary and a boatload of commission for a role. And I'm like, no, we need this to be the inverse. I'm not going to join this company unless my salary is massive and my commission is minor. And if I don't hit this, if I don't hit a threshold of what you need commission, like value of revenue wise, I'll fire me and I'll refund all the commission that I've earned. And they're like, okay, cool. So that gave me it was like 120 or 110 or something. But that was a part of my negotiation. So you can do that stuff. Like when you're going for a new job and they're like, oh, well, we're only going to give you 100 or 80 or 60. Where my value is 75. Great. Give me that. You can get away with a lot.
100%. Yeah. I think it's part of the overall mix, right? So at the end of the day, I think people lose sight of this a little bit. Either they get too wrapped up in, this is my career and, this company's great to work for and all this kind of stuff. It's like, okay, well, if that's really what you're genuinely enjoying, then go for it. But, if you have an ambition to be in the top 1% of property portfolio investors, then you have to challenge the status quo and you have to take, you have to say, I'm not going to take no for an answer and find a way around it. If you're not getting what you want, you got to go and find it somewhere else. So, I think, if I was doing it again today, I'd have to go and find a role where, that earning capacity, and like I see it all the time now, right? I'm in different industries and what people get paid in different industries. And so, I'd gravitate towards something that's, commission based and a huge sort of ceiling there that you can just go for it. If you're results orientated, there's sort of no cap on what you can earn, then those are the sort of roles that I would go for.
Yeah. I was just going to say though, at the same time, if like everybody's in a certain different stage of life, and we had Ricky on last week and he was at that 83K income. And for him, the most important part was the flexibility to go to work from 10 to 2. So he could pick up his daughter and do all that sort of jazz. And he still managed to find a way. The thing I picked up from that is you said there has to be a way to do it. So he still figured out a way to do it. And he just had to buy lower value properties. So that dovetails into another question. What is the biggest challenge that I want to ask about with the strategy piece that because you probably speak to 50, 100, 150 investors, maybe more a month around that. What do you see that people is it lack of focus? Is it lack of execution? Like where are people going wrong with that strategy piece that people talk to?
It's a good question. If we're talking generally, because I mean, a lot of investors, right? They're crushed in terms of servicing. That's the number one challenge. And if you've got an established portfolio, it is quite difficult you can do a lot of things, restructure debt, and then do things in a certain way. Look at using a non-bank strategy, but ultimately, you're still stuck in the corner in terms of serviceability unless you do something to completely restructure, and maybe you have to restructure and pull things apart, sell assets, move things into trust, all that kind of thing. It can be messy, right? But I think from what we see, the vast majority of population aren't backed in a corner on serviceability. They've got serviceability, they've got income, they're just not doing anything with it. And sort of the term came up the other day that I heard I really liked is that so many people are too busy to make money. I just thought that's a great term. I don't know what people are busy with, but they're just not taking the action and committing to making it happen.
Yeah. Well, I guess there's a lot of fear, right? Like the fear of messing it up is one. The fear of interest rates, a property like what you said has gone from $280,000 to $580,000. Like, can it go to $1.2 million? Like the same property to go from there? Like, how do we overcome that?
Yeah, it's great. I mean, there's a million different messages out there that people are absorbing. And look, when I was starting out, the media wasn't what it is today in terms of the share of voice. There wasn't social media. There wasn't, you pick your phone up, it's a smartphone. Back then, they were talking about phones getting smaller and smaller and smaller. And then next thing you know, they started getting bigger and bigger. And now people spend a great percentage of their day glued to it, looking at what the news is telling them. And unfortunately, that sinks in for a lot of people. They see the headlines, the sky's falling, Donald Trump's doing tariffs. Oh, he's doing tariffs. We can't buy an investment property in Melbourne now. So, it's kind of
at least no worries down in Melbourne, but no.
Yeah, I know. Exactly. Literally, I heard that WA is going to crash all of a sudden because of Donald Trump's tariffs. Not because the US imports minerals, because China imports minerals, and they're going to get upset with. It's like, where the hell did you get that connection? Like, yeah.
Yeah.
So how do you block that out? How do you get over that?
So I think you've really got to ground yourself in the fundamentals, right? So back to that sort of fundamental understanding of, okay, well, what drives markets, right? Supply and demand, and what's happening with supply and demand in Australia. Well, let's face it, no one's going to face into that problem politically. Every time the government touches housing, they make it worse, they don't make it better. So look at what's on the agenda for this election. Libs are going to help first home buyers. Labor is going to help first home buyers. That's going to help mostly existing property owners, because all you're doing is printing more stimulus and then pumping that into the bottom of the market, and that's going to lift all boats. So, it kind of doesn't matter which way of the political spectrum you want to swing. The governments are both sort of still jumping on the housing bandwagon. They're not helping the supply situation, the demand situation with immigration, that sort of thing, arguably maybe, but you can't just completely shut that off because we have a issue with our sort of labour force as well on top of that. So there's a lot to unpack politically, economically, that needs to change for the dynamic to change. And at the end of the day, it's an inflationary environment, right? In terms of more money gets printed over time. Inflation, I think, what's the target these days? 3.5%. I don't even know.
Two to 3% for inflation, you mean? Or?
Yeah. So you go, okay, well, the mandate is for there to be 2 to 3% inflation every year. That's what the government wants. So that's saying that everything's going to go up 2 to 3% every year. That's what they want. They don't want to be lower than that. If it's lower than that, they're going to do things to stimulate things so it goes higher. And yeah, if it goes higher than that, then they're going to do things to try and bring it down. But ultimately, because there's going to be inflation over time, markets are going to continue to grow. Your price of bread's going to continue to go up as well, right? But at the end of the day, if you can use somebody else's money to buy an asset that's going to grow in value over time because of inflation, then it's kind of a no-brainer. And so I think too many people get distracted with the microeconomics of it and the topical stuff on the media to go, these things are going to happen, and therefore I'm just going to wait for a better time. And then I'm going to invest when it's better, not take the view of actually I'll just invest when I can afford it. And if I can't afford it, I'm going to find more income, then I'm going to invest. Or if I don't have enough equity, I'm going to build my savings up or, wait for equity to be able to be released and then I'll go again.
Yeah. And I think what I'm kind of taking away from this conversation is just that constant check-in, that constant asking of questions. Like the Oz property portfolio, for instance, we're building $150,000 passive income in public. We've got 4 properties right now. We are constantly onto our brokers saying, hey, what's the finance in this situation? What is, can we pull out any equity? And they're like, actually, if you put 16 grand into one of these properties, you can drop the interest rate by a percentage point. So we did that. We put 16 grand in and that dropped a $1 million loan down, which then saved us $10,000 a year. And then on the other deals, great, we can actually stretch that. But it's constantly just, okay, like one of the answers was the valuations have come back and there's no increase on these 3 properties. I'm like, well, that's bullshit. These ones, I've added the bedroom. We've added the bedroom here. You have to now go and get a full valuation, get someone to walk through them. Oh, okay, we'll go do that. Boom, valuations come back. Now we've got more equity. Thank you. Okay, great. It's obviously you're not trying to be rude or anything like that to the professionals that you're working with, but you've got to keep, no one cares about your money as much as you, but you've got to be the one to drive it. Hey, what's going on with this? Let's get this equity out. And keep pushing it. Did you have a limit? Were you like, okay, cool, we're always going to refinance our loans for the first 5-10 years of your portfolio, but we're going to go 90%. It's always going to be at 80%, or every time we can get equity out, we will. Like, how did you think about that?
Yeah. By the way, everything you just said, Joe, that's kind of it. That's my journey. You behave like that, you act like that as an investor, you're going to be successful. You're not taking no for an answer, right? And that's it. You just keep beating down the doors until you find, what you want on the other side. So I think that's a great example. For us in terms of like structure and, we actually never went down, or actually no, I went for never. Once we went down the LMI path, back in the day, I think it was, you could buy, I bought 2 in quick succession. One, I used the equity from a property, and then the other one, I went, I still got some money left over. And you could do 98% plus, and the LMI cost was quite cheap back in the day. So, but aside from that, we would find like the equity was less of an issue than the borrowing capacity. So we would always be able to pull equity, if we had the borrowing capacity to support it. So we would always run with an 80% LVR strategy. We wouldn't just pull equity nilly-willy. We would when we were ready to buy, it'd be like pull the equity then and make the purchase. I know there's a school of thought, pull the equity when you can. I mean, maybe in a falling market, it sort of depends on your own circumstances, right? But yeah, we would just pull it out when we need it, when we can, and then make that next purchase happen. Because a lot of the time, we would need the projected rental income from that next purchase anyway to make it happen.
Yeah.
Yeah.
Interesting.
It's interesting because I think there's some of the properties we could talk to, and there's heaps of questions that have flown through. What I wanted, because you said at the peak you're about 15 properties, and how do you sort of think about, because I think this might unlock some insights of people, selling the property versus earning more and drawing that equity? Like, what is that equation? Is that purely mathematical for you, or is it risk-based? What does that look like for you, Rich?
Yeah, so I guess when we got to the point where we needed to fund development, that's when we started the rationalization process. Really, we did a few, like we did along the way before we got to that point. We did some tactical stuff. So we would buy an apartment in Sydney for 150K and do a $5,000 reno on it and put lipstick on a pig and sell it and make 20 or 30K profit. Not a lot of money there, right? But you got to sort of have the context of when you're coming from zero, anything you can do that's going to help the cause is going to be positive, right? So if we're making 30 grand on a flip, then that's 30 grand more than we had yesterday. So, we would do little projects like that. Sometimes the stuff that we would buy for a long-term hold, we would renovate, and then, something would come up. We go, I don't think the growth of this particular asset's going to justify, being a long-term hold asset. And so we would move out of that asset, take a little bit of medicine in terms of CGT, and then redirect that into a higher performing asset. Ultimately, when we were down the line, more recently, we've rationalized a couple of our worst performers. You just look at the compound annual growth rate and you go, well, like the worst one we'd ever bought had about a 3% compound annual growth rate. Just wasn't a good asset. And, I'd owned that for 15 odd years.
And that was one up in Logan, wasn't it? That was one up in Logan. We've seen significant growth, probably, hadn't it?
Yeah. And that's even with, I think I saw it in 22. Probably up till 2019, it hadn't actually grown at all. And it just wasn't a good asset, right? I mean, I kind of bought it with maybe an inner city mentality of it's a 4-bedroom house instead of a 3-bedroom house. People got to be into that. I was on a small block of land and it was surrounded with other houses that were almost identical to it. So, supply and demand didn't have much differentiation, didn't have any sort of future development potential. It kind of didn't make that much sense. I should have bought one down the road that was on a bigger plot of land that I could have put a granny flat on. But, you don't think about these things when you're really early in your investment journey. You just buy what you think is the right thing, and you kind of go from there.
It's also a bit scary as well. Like buying those type of, like thinking of those value add deals for your first one. I don't think that you need to necessarily, like, I guess what I don't want to say is don't look at them, because you should absolutely. Value add is such a valuable vehicle, but don't stress yourself out too much. It doesn't need to be the first one, but start thinking about it for the second and third one, because you can really start to elevate your portfolio beyond. But don't think, oh my gosh, now all of a sudden I have to go out there and find a high growth market and find the market is going to do most of the heavy lifting. So choose the asset and choose the market, then choose a house with established land, is probably going to do 95% of the work. And then if you can get value add on top of that, awesome. But if you can get a nice set and forget that stacks up, then it's going to do a large percentage of the work. Sorry, Jeff, what was that question?
I answered it anyway, but it's about having a mind answering questions, people. So because you kept saying we, and people have said as well, did you? Because where there's recurring questions, it means that a lot of people want to know the answer, probably most times. So you said, did you have money partners, so you renos, or is that, and people have said we, like, and I said it's, when you say that, it's probably Mel and yourself, or did you have money partners? Like, how did that look?
No. Look, I like the term success as many fathers, but in this instance here, it was just Mel and I. The only exception to that ever has been when we did a development and we had a JV partner when we were 50-50 on a project, because it was a big one. But yeah, otherwise I say we because it is a team effort. Both of us working together on that. There's no way I could have done it on my own. It's not possible. Borrowing capacity, all that kind of stuff. Just it's not scalable enough on one income. Certainly not an income that I could have achieved. And then B, Mel is just as keen and hands-on as I am with this stuff, right? So whether that's, jumping in and doing a cosmetic reno or, styling a property or whatever it is, she absolutely loves it as well. So, yeah, definitely a joint effort in terms of us being a team.
And I remember that Mel actually introduced, after we had a chat, Mel on the podcast, she said, come and have a chat to Richard. And she was the one that kind of pushed you because you're a little bit uncomfortable about coming on podcasts and all that. So now you're relatively a seasoned pro. But shout out to Mel. She's an absolute powerhouse as well. And I hope she's, somebody said we're going to go down too many rabbit holes there. Sorry, David. We won't ask that one about disagreements, because who knows? I think there's disagreements galore with people left, right, and center sometimes, but maybe not. And this.
Yeah. No, sorry, Jeff. You go that one.
I think this is one from Ricky, and then Serena dovetail in the back of that. So Ricky asked, and I think that development was a real, and I don't know if that's the one you had the joint venture, but he asked, people usually ask what you did right, but I want to know what you did wrong. To get to that 30 million, you must have made mistakes along the way. We've made mistakes. Joe and I made mistakes. We'll go for my first property was a mistake. But anyway, about you, over to you. What mistakes have you made, and what did you learn from those?
Yeah. So as much as we could talk a long time about, successes and all that kind of thing, I think I could talk even longer about mistakes. So The big ones, and look, mistakes. I hear my kids say mistakes are your friend. That's what they get told at school these days, and that's true. That's a great mindset. But geez, I tell you what, when you're making a mistake, it doesn't feel like your friend. So the big mistakes that we made in our journey, the biggest one by far would have been when we'd gone through this period of buy and hold. We've done a few kind of like apartment flips. We've done a few renos, and I can't remember the year. I think it's about 2012. We've gone, you know what? We should be property developers now. So we exchanged on this property. It was in Hurstville on Croydon Road, and it was a raw site. It was about 1,500 square meters, and thought it's got an old house on it, and it's all busted up and whatever else. And thought, okay, well, yeah, we'll buy this. We'll put 4 townhouses on it, 6 townhouses on it. I don't even know, like, how many townhouses can you put on it? Let's just buy it. Back. And we went up that learning curve pretty violently, where we didn't know what we were doing. We didn't know the process.
Is this the joint venture you did? Did you go 50-50? No.
Just us on our own. It was
all your money, all your mistake.
Yeah. So this completely tapped us out at the time. It was everything we had in terms of capital and borrowing capacity. The alternative was to keep doing the buy and hold thing, right? And because that was working quite well, but we thought, let's do some numbers here. If we build 4 townhouses, we can make, I don't know how much money it was at the time, but we were attracted by that, right? Because a lot of people they see the success story of the development and think, you can jump in and have a crack.
I'll do that.
And I think, there's so much to unpack there. It went wrong. We didn't know what we were doing. And after about 18 months of trying to push this DA through council, it became evident that our architects also didn't know what they were doing. But because we didn't know what we were doing, we didn't know that they didn't know what they were doing. And we then got a hold of a draftsman who got recommended to us. And he had a look at it and goes, this is never going to work. And so he made some tweaks to design. Within 3 months, we had it approved for 4 townhouses. And we kind of had a sigh of relief because that was great. But by that stage, we were still both PAYG then. It was burning us pretty badly. I think it was costing us about $76,000 a year in holding costs. Well, we had someone in there, I think they were paying about $300 a week. But it really didn't make much difference. I think rates back then might have been about 7%, and they were actually going up. So it looked like, this is where the media kicks in, right? It looks like rates are going up, city prices are going to go down. There's nothing that we can do here. We don't have enough money to complete the project. So we ended up selling it, DA approved, basically 2 years after we bought it, for $20K less than we bought it for. Plus then you add in the holding costs, the stamp duty, you add in the consultant costs. I think we lost somewhere in the realm of $250,000 on that, and burnt 2 years, 2 valuable years. And it was a lot of stress, a lot of pain. And it was something that we sort of walked away from going, oh, shit, what happened? That was just absolutely brutal.
Such a waste of time.
Yeah, we kind of looked at it and go, well, we know what we did wrong. We didn't know what we didn't know. And, there's so many lessons out of that. It's like if we would have had a mentor on our side, or somebody that we knew that had done this before, then, we could have learnt those lessons without having to go through them ourselves and having to make that expensive mistake. But, like I said, I kind of learn by doing sometimes. So you got to go through this baptism of fire every now and then come out the other side. We knew this draftsman. We went, okay, well, what can we do next? And that sort of led us to go, well, what's the lowest risk thing that we can do? We went and bought a little semi in Annandale in the West, and did a DA extension, did an owner builder. The draftsman was able to refer some trades, and we sort of started growing our network of trades and builders and all those sort of consultants from that project. And we're able to, continue to sort of scale our understanding of things and that network from there. And that project, fortunately, was a really good bounce back. Like we made good money on it. By the time we built it, we ended up having our first child, and we needed a bigger place to move into. So we ended up selling there and then doing it again with another bigger place up the road. But we made good money on that one. I think it cost us about 700K, and we sold it for 1.36. The works were only about 250K or something. So over an 18-month time horizon, we was kind of our little comeback. Okay, well, we're now proving to ourselves that we have the ability to do this, but we now know that you need to go into these things with the right team on your side, as opposed to just try to jump in and making it work on your own.
Thanks for sharing that. And I mean, we could go. I feel like haven't uncovered a whole bunch of your portfolio, but that's encompassed the thing that Serena's asked about 100 questions. Thanks for that, Serena, and I'd love to ask, because they're all fantastic questions. What I wanted to know is what's actually sorry. There was a question about, somebody asked, how do you find a trustworthy mentor that isn't there just for the money? Is it the questions you ask? Is it the relationship that's been referred? Like, how do you find those people?
That's a good question. I mean, to be honest with you, like, I've never really had a mentor as such that hasn't come about
professional, like any kind of person, mentor, professional. Sorry, but
yeah. So the only mentors I've ever had are as a result of a professional relationship, right? So like, I had a mentor that I met who was a fantastic broker. I've got a mentor who I've met who's a fantastic business coach. I've got a whole heap of different kind of mentors in different capacities. And each of them, they're an expert in their own field, but they've always come about as a result of a commercial relationship, I suppose. It's really hard to try and find a genuine mentor who can, spend time with you and show you the ropes, so to speak, if there isn't a commercial relationship, because it's kind of like, like trying to find a unicorn, I suppose. It's just time, right? And I mean, the one thing I think over and above wealth, that we should all be cognizant of is time, right? And which is why I don't like wasting time with anything, and like, I don't like wasting time with investing and sitting on the sidelines and not doing anything. I'm always wanting to move, because time is so precious. Time is so rewarding when you get it right and you're invested over the long term. And time is something that we've all got a limited amount of. So, trying to make the most out of that time, I think it's very important.
Yeah, super interesting. That's the right way to think about it, because there's no one mentor that's going to give you the silver bullet. And I think that's what you learned from your draftsperson friend, right? Like, person. You're an expert in being a draftsperson. You're an expert in town planning. You're an expert builder. But try and get those relationships from somebody else that you have a lot of respect for and that super smart and switched on, or someone that's done work with them, like your mortgage broker. Great. Do you know any good builders that have actually built a townhouse unit in wherever it was, Hurstville? Yeah, actually, I know 3 guys that have done that, because brokers know a lot of people, accountants know a lot of people, but there's no one size fits all mentor that's going to teach you absolutely everything about everything. But so many people along the journey that are so switched on, that can give you so much information that is in their head, off the top of their head, and they say it like it means nothing, but is 10 years of work distilled into a easy sentence of like, yeah, you'll easily get that through council. Oh, but there's an easement at the back. Yeah, well, actually, that's a stormwater easement. It helps the development, in fact, because there's a stormwater drain here, and here, and the electricity's there. This is the best. You got to buy this site. This is great. Sweet. But if you don't have those people, so reach out and try and find them. I mean, how did you, maybe that's the better question to ask. How did you find these types of people?
Yeah.
Or how do you do it now? Because you're still doing the same thing, right?
Yeah, 100%. I mean, and now I guess I'm in a fortunate position where I just get exposed to so many different people, so many conversations that, organically, day to day, I'm just getting exposed to so many different people who are experts in their field, and not necessarily just property, business, just through networking and through business. I'm very fortunate enough to have very organic conversations all the time. So I'm growing that network, which is fantastic. But then early days, you don't have access to those people. So you need to start with, I think you need to start with assembling, your basic team. If you're starting out as an investor, you need to go out and you need to find, your superstar team that's going to try and set the platform for you at the start. And I mean, really the core of that, I'm not trying to be biased here, but the core of that these days, it is a broker and it is an accountant, absolutely. And then outside of that, it depends on what you're looking to achieve. If you want to be a developer, then you need to try and find people that work in that space who can help coach and mentor you along the way. It might be a draftsman, it might be an architect, it might be a town planner, so on and so forth, and then sort of building it out through there. It might be if you're looking to buy and hold, you might be wanting to build relationships with different buyers agents to go and get understanding of, okay, well, when I'm ready to buy, which one am I going to use? What area am I going to invest in? Whose strategy do I like the best? It's just building relationships with those people to start you off. And they might not always be the people that you work with forever, but at least you'll get a view, and then you'll be able to use that as a platform to learn from, and then accelerate your learning so you can move faster.
Yeah, that's fantastic. I think that's probably 2 minutes. I hope somebody makes that into a clip. And for us, and for me, that's how, I don't know about you guys and probably Richard from the sounds of it, that's roughly how I started. And some people will be like, oh, I'm sorry to be, and they'll laugh maybe at you and say, well, look at this person asked this silly question. I'm sure that happened to me 100 times, but I just kept remaining that persistence. And eventually, there you go, self-mentoring.
This is a great comment that's come up from Cameron J. Self-mentoring. Step 1, bite off more than you can chew. Step 2, chew like fuck. Step 3, when you start to choke, keep chewing. Step 4, repeat. It sounds like they've summed up your experience. We don't need a podcast anymore. That just lined it up perfectly.
100%. And it's nails that you're chewing. So a lot of fun when you're going through it.
Keep eating glass.
One of we've got to jump to an ad shortly, but one of the anyone that's got questions, throw them in now, and we'll try and get to as many as we can, because we do like to get to as much. But one of the questions I have is around motivation, and it's been some of the comments that I'm seeing come up and around here. Like, I guess, how do you keep pushing and doing it? Because there's a point at which you could live right now a very comfortable life at $20 million property portfolio, at $10 million property portfolio. You might not be able to live a Revolto life of $1.2 million sports car at 10 mil, but you could live a very, very good, comfortable life. Like, how do you? Because in the back of my mind, I'm saying, oh, dude, I'm done. I'll take all that $2 million, that $1.2 million sports car, put it into a 6% commercial that's giving me, what's that, $130,000-$140,000 of passive income, and live the rest of my days. No, actually, maybe not. You need about 2.2. But what does the motivation look like around that, and how do you keep pushing on, and why?
Yeah. I guess these days it's kind of got to a point, right? So when I left the commercial, or not the commercial, I left the PAYG world. That was kind of the point where I felt like we were financially comfortable. I felt like that we've got enough. And then it just sort of happened organically, where it's like you can create this sort of ecosystem of your life, where instead of doing things that you're not doing for your own sort of benefit, you're doing things that you want to do, that you enjoy, and that you're good at. It's a whole different ballpark compared to going, I can just hang the boots up. Like I tried that for a week, right? And there's only so many long lunches you can have, before you get to the weekend and go, oh, geez, I'm knackered from this week, and I don't know what to do this weekend. I get bored really quickly, and so we're fortunate enough that the way that the business has gone, and with what we do with property, like, genuinely get up every day and I enjoy it. Doesn't mean I don't have bad days, but I'm just enjoying doing what I'm doing right now, and so I'll just continue to ride that train until one day I wake up and I go, I don't want to do this anymore, and then I know, okay, well, now it's time to go and dump some cars and buy some commercial assets or downsize the house or whatever it is. Like there's plenty of different exit plans there, but right now I'm just enjoying what I'm doing. So the motivation's not an issue.
What about 10 years ago? What did that story look like? Like when you're in the, was the motivation exactly the same? Because I look at this and it's just struggling the entire time. You're doing developments that aren't working. You're doing deals that are taking ages. You're doing these, like a $30,000 reno flip. Like, oh, kill me. That is exhausting. Yeah. Constantly going to the broker. Constantly. Why aren't you doing your job? Like, this is your job. You should be doing the numbers. Why am I having to come to you? Like, it gets to a point of like, yeah, it's not really worth it. Like, what was driving you back then? Has it, or is it nothing's changed and it's remained the same story?
Yeah. So I think now, it's kind of like doing it because I want to do it. Back then, we were doing it because we had to do it, right? Like, I mean, you don't have to do it. I mean, sure, you could probably pull stumps once you've got, 2 mil net, and then, allocate that into some passive investments and go and do the fire movement and whatever else. But for me, I had a certain target, and it
said
sort
that
of
with like such a disdain.
It's not what look, respect anyone. I've
Yeah.
lived that fire life, right? Like, I mean, when I was growing up, I had a $120 a week budget, and I would be thrilled when I came in short of that, and which was pretty much every single week because I was so strict on what I was doing. I'm walking. I'm walking places instead of taking a bus because I can save $1.50. That sort of stuff, right? I mean, good on you if you can do it. I can't do it these days, obviously, because I don't want to. But the thing for me was just that sort of powerful anchor of I have a target and I have to hit it in terms of like a sort of net wealth and all that sort of numbers thing. Until I get there, I'm deeply dissatisfied with where I'm at. Not miserable or depressed or anything like that, but I've got that. I think someone called it healthy dissatisfaction once. We'll run with that term. I have this healthy dissatisfaction. I'm going to do everything I can, keep knocking down those barriers, keep opening doors until I get to that target.
And so is that actually, that's a question. Was there a target? Was there my target is a Lamborghini Revolto, which means I need to have $1.2 million of cash, which means that I need to have a $20 million property portfolio to be able to get X amount of equity out to then pull it out and then plop it into my car? Or like what were the targets you were aiming for? Because I, like what you said at the outset, my dream was to have a 1/4 acre block with a Commodore on the driveway and a mowed lawn. Like the goalposts keep shifting. What did it?
Yeah, well, they do shift, right? I mean, this is a product of inflation too, right? Because when I was a kid, I was going to retire at 30 with a $1 million net wealth in Hornsby Heights. But by the time I was 30, did I have a $1 million net wealth? Yes. But was that enough to retire at 30? No. So it's kind of like, we had a target. Look, I think it was a 7 mil net wealth target. And we got there and it was kind of like, oh.
At what age?
Oh, geez. It would have been
like
mid-30s.
35 or something.
Yeah, so I've literally got it in a spreadsheet somewhere, but it's kind of so insignificant. Like at the end of it doesn't matter, right? It was just an internal motivation thing, we kind of got there and went, oh, well, we got there, and then about 48 hours later, you ask the question of, well, now what? I think having purpose, I think it is a big thing. We sort of got to that point where we reached those targets and went, okay, well, we're doing property development, which is a different game. We're making good money doing that. So we'll continue to grow, in terms of, financial position at a rate that's going to be more than acceptable. So we don't need my PAYG job anymore. Mel already left hers, and so then you're in a position where you've got that financial freedom. You can do what you want to do when you want to do to a certain point. And in that target, there wasn't anything extravagant, right? It wasn't I need to have a Lamborghini or anything like that. There just wasn't anything like that in there. But it kind of escalated, I suppose, years later when you keep doing what you enjoy and you're good at, it keeps compounding. And, you know, like you get to 2020 or 20, when you're holding a lot of property and you have a year like 2020, 2021, it's, you know, that's kind of what a property investor lives for, the boom times. So yeah.
Having said that, booms happen like 2013 in Melbourne, Sydney, COVID, like late 2000s in Sydney, not late 2000s, but there is going to be more booms, people. It's okay. Just because you didn't have $10 to $15 million worth of property in 2020, it's okay. But it's just interesting because to me, I would get to that level and I'd be like, okay, it's time to focus on something else. But it's just, and it's not, like I just don't, and maybe I'll get to $5 to $10 million worth of property or assets because I love property, and maybe I'll think differently. We'll have to have a chat then, Richard.
Yeah. The challenge that I see with investors that do incredibly well, like we work with a lot of investors that crush it. I'm now good at it. I'm now very, like, if there was $100,000 on the sidewalk, would you pick it up? Yeah, I probably would. I would pick it up. And it's like, but all I need to do to get access to that $100,000 is get this person, get this person, get this person, get this deal, and do a little bit of work. And it's like, it's irresponsible not to do the work and get the job. And also, I got to call my friend, the broker, my accountant that I haven't spoken with in a couple of months, and like it's weird. It becomes a bit of a game. The other question, sorry, I know we got to jump to our sponsored bloody thing. And questions, guys, chuck them in there because we'll try and get to as many as we can.
It's a great
cautious of time.
Yeah. Respect.
No, it is. No, I know. That's why I want to get to it. But what I was going to say, Rich, is what metrics should I be caring about and tracking? Because was it just the net wealth, which is your debts, your equity minus your liabilities? And then you said, we need a $7 million net equity. Were you looking at a cash flow number? Were you looking at a equity number? How did you set those goals? Because that might be powerful for some people.
Good question. I don't actually know why I hung my hat up on the net wealth thing, to be 100% honest with you. Like looking at the numbers, you could look at it anyway, right? It was more just, for me, that resonated. And I think, you know, for other people, it's probably going to be, well, you know, passive income. Can I get to this target, or, you know, can I get to this total income target in terms of property, or this amount of property, or whatever it is. Whatever the target is, you know, set it for what drives you and what sets you on fire. For me, I don't know why net wealth was just a thing, because that, at a very, very simplistic level for me, you know, if I plug that number into a spreadsheet and I don't change anything, then, you know, I was pretty happy with the shape of those numbers with compound growth over the next, you know, 30, 40 years, right? And so that was just the number, and it's kind of, that was the thing that I said. Well, at that point, at that level, you have choices, and so whether you're selling down, putting assets, you know, selling down resi, moving into commercial, you know, keeping the resi, just letting it play along, you know, you're going to have positive cash flow because you can pay out debt, and, you know, there's a million different things you can do when you get to that level, and so that was kind of like. And look, I think to think about it a little further, I think it was based on like a, you know, a certain footprint of these are the investment properties and this is the owner occ and this is the level of cash we need to get to, and it was really as simplistic as that. So
yeah, if we have $7 million net, that means we've got X amount of cash flow, which means we're absolutely fine. And and then you got to 30 mil. So okay, let's jump to this ad and we will then chat to
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For OzProp members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
We're back, and Joe's not. But that's a great book and commercial, and I do love. There's so many other questions that people have asked, but I just wanted to say, because it's interesting your perspective taken about capital growth versus cash flow, and I think a lot of people to start and even towards the middle of their journey, they kind of focus too heavily on their cash flow, which resi property typically isn't great for it. But is that kind of why? Because I was thinking when you're talking through that 7 million and it kept growing, is that kind of why your capital growth was the core focus and the net wealth? And then over time, the cash flow will take care of itself. Is that your mindset, Rich?
Yeah, 100%. So the power for me in property, it's not cash flow based. If you want cash flow, then, resi, I'm talking resi. I mean, obviously commercial, you can get better cash flow out of that. But for me, it's the growth, the capital growth of property over time that makes you wealthy, as opposed to the cash flow.
Yeah, that's right. I promised people there would be some insider advanced tactics that multimillionaires they talk about a little amount. So what are those little known tactics that people should consider that aren't really talked about that much, or do they exist? I just wanted to ask that.
Yeah, I mean, really, there's probably one sort of niche. I mean, once you become a sophisticated enough investor and sort of high net wealth, you can move into the private bank space with the majors, and there's some stuff in there that they can do with things that they'll call bullet loans. You don't necessarily have to show serviceability on assets, so. There's a little snippet of something. The reality is though that there's no real shortcuts, right? I think it's in order to get to that space to be able to use a little niche like that. And look, I'm not using that niche myself, but once you get to that point, you had to have done the work to get there, and you've had to have sort of followed the principles. I suppose really the thing that a lot of people do follow these days is the trust strategy, but it is a double-edged sword. Going down that path, you really need to be committed to the purpose of why you're doing it, and sort of the vision of what you're going after, and you need the right team on board who know what they're doing in terms of your broker and your accountant especially.
So, what do you mean double-edged sword? Like, what are the kind of things that people are getting caught up on and avoiding thinking about or not talking about, and then you see that, like, oh well, shit, you messed that up.
Yeah. Well, I mean, I've always loved investing in property as an individual because of the tax benefits of property, right? So if you're a high income earner, you own that property in your personal name, you've got the negative gearing. That's a great little bonus that you've got there. Obviously, being in a trust, you don't have that same structure. You've got that thing isolated in its own entity. That entity needs to be trading profitably in order for you to be able to exclude that. So you're either going to need to make sure that the asset is structured correctly and it is a cash flow asset. Sometimes a cash flow asset isn't going to be the same asset as a capital growth asset. So there's a lot of little nuances around this that you need to get right. If your accountant's not comfortable, he's going to write a letter to say it's trading profitably, as an example, then kind of hits the strategy on the head, because then you have to show the full financials of that trust, and then they're going to see that there's debt inside that trust, and you have to put that in your serviceability calculator as well.
But I mean, that doesn't change. I mean, if you are stuck from a serviceability standpoint and you combine your personal name, then it doesn't really matter because you've just bought that asset. It's outside of a trust and you're still negative. So it then becomes a benefit when it becomes like, alternatively, when you have the personal. Anyway, I'm not trying to dispute the pros and cons of trust. Okay. So that's one of the negative sides. Any other little things that people get stuck, tax, and then actually getting it positive, like that's going to take years. Like it's not a 2-week adventure. You have to buy residential. You then have to do, a development or a granny flat or buying a super duper high cash flow market and still do a granny flat or a subdivision and get a house on the other side of it to get it cash flow positive, or just buy a commercial property inside that and move it positive as well. But it's not a straightforward straight shot.
Yeah, that's right. I mean, a lot of the time, if you're buying an asset where you can add cash flow, so you chuck a granny flat in the back of it, you've got capital to do that, or whatever it is from an equity release, and another property, then that's a fantastic way to go from a negatively geared or a non-cash flow to a cash flow asset, and then that's the sort of high yield investment that suits a trust strategy, right? Commercial lease stock's the other thing that a lot of people use, in the commercial world, which is essentially doing the same thing. You get to sort of maximum 65% LVR in the most case, the special, vehicle that you've set up for that will self-serve in terms of washing its own face with serviceability. You can exclude that from serviceability ongoing. So it's a very simple one in terms of the commercial structure.
Okay, I've gotten very greedy with asking my own questions. Let's jump to some of the questions. I am cautious of your time as well, Rich, and thank you very much for sharing all your insights and knowledge. Actually, just before, when Jeff's hunting around right now through the comments trying to find one. So while we wait for him to find one,
No. Oh, okay, well, come on.
Go on. Okay, go on. I saw the word Ferrari, so I like this.
Yeah, this Kushal has asked this question twice. So if you really want to get my attention, actually, I'm not going to say it. We want to know how much did the Ferrari Club help in the investment journey? Could that be quantified like I'm sure he's got it in the spreadsheet as well, pre-Ferrari portfolio versus post-Ferrari portfolio. What does that look like, Rich?
Good.
Great question.
Good question. Yeah, look, I think this probably goes back to the networking piece, to be honest. So we bought our first supercar, if you like. It was a Ferrari back in, we ordered it, I think it was 2021, and arrived 12 months later, 2022. I think, I don't know, all the years kind of sticking to one for me. But that opened a lot more doors for us with, I guess, like-minded people. So you find other supercar marques, particularly Ferrari, I think it's a slightly older demographic. But a lot of these owners of cars like that, they'll come from similar stories. Not necessarily property, investors or developers, but people that have started a business and they built that business up over a long period of time. And the sort of fruits of their labor is they've always loved cars. They haven't been able to afford one. Now they've got one and, happy days. So there's a lot that, people like me can learn from other people like that, who've had great success in their fields. And, you kind of have a lot in common, having been through a very similar journey. So I've certainly learned a lot. About business, about life, and I guess the application of a lot of the information over the last few years has been probably something that's helped me in my own journey. It certainly opened a lot of doors. I mean, in the end, we don't own a Ferrari anymore. We've got Lamborghini and McLaren and whatever else, and we ended up starting our own car club, actually, because there just wasn't anything that was sort of like a, there's a Ferrari club, there's a Lamborghini club, there's a McLaren thing and whatever else, and there's a Porsche club. And I thought, okay, well, where do you go if you don't want to follow the brand blindly, right? If you've got a couple of cars or whatever. So we ended up starting this thing we called the Fast Lane, and we've got like an inner circle membership to that club, and really it's filled itself. I think we've got something like 70 paid members in there now. And like I say, very, very similar sort of origin stories for a lot of the members there. They've got successful businesses and they've built them up over a long period of time. And so, we set up events and do things with that group. And, whether that's, a trip to the Hunter for an away night, or, we'll go and have a lunch somewhere, or see a new car that's being launched in the showroom and get access to that. So, that property is one of my passions. I love my family, obviously, but cars is a massive one for me. And then being able to do that has been something that's been a lot of fun for me.
Can you rent the car to come along, or do you have to own the Lambo? Probably have to own it.
We can make an exception for you, Jeff.
I don't know.
Yeah, just don't tell them that it's rented.
Okay, here we go. On to the next one, because I'm going to do some rapid fire now as quick as we can. We're going to get as many questions. And Joe, you pick some while I'm asking this one.
Yeah.
So you pick a couple. Interested to hear, very high level, what kind this is a selfish question I want to know as well. What kind of development you're doing in Sydney right now? Are you doing much in the way of development? I think I know the answer to this, but.
Yeah, there's another point I probably want to make is what worked yesterday might not work today, right? So we've done a few duplex builds in the inner west of Sydney, and back in the day, when we were doing it circa 2015, 2016, the feasibility worked. It wasn't as mainstream a strategy. Go back 20 years ago and renovate a unit, you could make money flipping an apartment because nobody was doing it. This is, pre the block. You could do a terrace renovation, make 150, 200K with very little risk because no one was doing it. Nowadays, it's harder than ever to try and find these little niches. And so at the moment, the only active project that we've got is a single house build in Bellevue Hill, which is what we did previously, which is where we're living right now as an owner-occ. So
like an upgraded PPR.
Well, we're actually downgrading this time. Well, that was the plan, but anyway, that's a story for another time. But at the moment we're exactly. So that's just going to be a single house build there, and there's not a tremendous amount of margin in it, if I'm entirely honest with you. The way the market is at the moment is probably not as strong as it was sort of mid last year. But we're doing it for tactical reasons to try and downsize, and hopefully have a little bit more capital and borrowing capacity than allocate into different projects.
Yeah, but also like one of the things you just mentioned there, like duplexes in 2015 worked well in Sydney, right? So go look at what Sydney looked like, 10 years ago and find the areas where that is starting to shift and change, right? Like there are areas where a duplex development is the best thing that you can go out there and do. I think renovations are actually becoming very, very challenging right now. Across the board to make real money. Like Jeff and I, we're doing a renovation and the numbers look great when you say them real fast. We bought it for $530. It's then been revalued for $630. And we're spending, we did a renovation for $70,000. It's like, oh yeah, that's great.
I thought it was 50, Joe. Did you exceed the budget? I thought it was 50. Didn't you or did it go up again?
No, we've exceeded the budget has been exceeded due to cost blowouts. But there are areas exactly. But there are areas where a development works really well. There's areas where granny flats work incredibly well. There's areas where renovations are the best thing. Like regional Queensland right now, don't even try and get a painter. They don't exist. We had we were looking at a deal and it was $25,000 to paint a 3-bed 1-bath. Like you can't make money. Because there's no trades available.
I'll fly up tomorrow. Let's go and do that job, Joe. That sounds fun. I was going. Yeah, think of the margin.
The guy, the investor did. He's like, okay, I'm going up there. I'm going to get a paid trip to the area. But okay, so this is a really good question that's popped up here. What are some of the more surprising things you've learned about people or property or money along the journey? And if you're feeling very generous, one of each. But what are some of the more surprising things that have jumped out at you that you didn't expect?
Oh, geez, that's a really good question.
Yeah, while you think about that, I've got one off the top of my head that I think is very good, is the amount of generosity that people have with their knowledge, the amount of information that amazing people have, and you can just jump on the phone and have a conversation with them and they will give you and share their knowledge. Obviously, you don't want to be an annoying little prick and say, oh, no, just one more thing. But you can actually like right now we're doing a potentially for the Oz property portfolio, a rooming house development. Our property potentially, based on the rules and regulations, could fit a rooming house development. And I'm having so many conversations with experts in this area that are just like, yeah, man, I'll have a conversation with you and let's just have a chat. So pick up the phone is
if you need somebody,
pick up the phone is the best. Yeah, okay. Well, exactly. We'll pick up the phone, Jeff, and have that conversation. But pick up the phone and you'll be surprised how generous people are with their expertise, their knowledge, and but always double check it as well. Like if someone says something that's like, whoa, that sounds strange, flag it in the back of your mind, write it down, and then flag it with somebody else and say, hey, yeah, I was chatting with my friend's accountant, who's my cousin, and he said that trusts are the best thing since sliced bread because they do this, this, and this. Yeah, but also the downside is this. Oh, cool. Now you've got the full picture. Anyway, on to you, Rich. What's the most surprising thing you've learned about people or property or money along the way?
Yeah, I suppose the thing for me, if I was going to try and wrap all three of those things up into one, it's just that there isn't an abundance, right? I think,
There is, or
maybe in
there
my
isn't?
early, there is absolutely an abundance, right? So when it comes to property and wealth and the ability for people to make something of themselves, I think a lot of people have a closed mindset to go, okay, well, if I'm winning, somebody else is losing, and I think maybe early days I did have a little bit of that attitude as well, where it's kind of like I need to do everything that I can to win, and maybe that was negotiate every deal, every dollar out of every last deal, and everything, right? But I think if you can open your mind, and I think the people that I see that are the most successful are those that have opened their mind to go, okay, well, just look at things a little bit differently, challenge the status quo, and kind of open yourself up to the opportunity of doing something different, and having a crack. And I think, if you look, if I sort of reflect on my journey, if I reflect on a lot of the learnings that I've seen out of the industry and a lot of the other successful people that I know, it's that they've taken that leap of faith, because they know that there's so much opportunity out there. That if you put the work in, you have the right team around you, then really, as long as you're willing to put the work in, you're going to be successful. And I guess I kind of tell people that if I can come from where I came from, which was ground zero, and got to where I am today, then if I can do it, anyone can do it.
I like that. Yeah. That's just like it encapsulates everything. You sort of talk about there's abundance, and there's also about, because there is so much information out there these days, and the first person you speak to who's a professional out there on YouTube, they might struggle to get back to you because they might be going through a lot in their life. They might have a lot of commitment. So it's not a reflection on you if they don't come back to you. It's probably a reflection on what their life and their circumstances. But keep reaching out to those people. Keep knocking on doors.
That's Jeff saying, don't message me anymore. Please stop.
No, I'm getting back to, because I just enjoy, like I stay on the phone. If a meeting's half an hour, I'll spend, if I feel there's something I can add, I'll keep going. So anyway, on that note, any creative ways to maximize rent or property value that others may overlook? And this is, I suppose, from a broking perspective, because you would sort of see some really cool stuff happening, but also in your own like development, some renovations you've seen. So what are you kind of seeing in that space, Richard?
Yeah. Probably the one thing I would say at the moment where you can get a tangible ROI is if you're spending money, like the basics when it comes to reno, to enhance rental yield. So, you might not see that there's a commercial sort of, I'm going to spend 10 grand and I'm going to get 30 grand back in asset value these days. But like rental income is certainly, that's something that that's a strategy we pretty much used throughout the entire journey, is just trying to find a way to enhance the return that we're getting. So the basics of, the reno stuff is definitely an easy win there. But the other thing we did with quite a few of our properties, which were more in the sort of inner suburbs of the major cities, was look at doing a furnished strategy. And that's not, we're not talking Airbnb there. But it's, if you can put the major items in terms of the major infrastructure that you have in an apartment, what you'll find is you can get a higher rental yield than if you just had a non-furnished apartment. And a lot of the time, like if you go around Gumtree and Marketplace and that sort of thing, and this is the sweat equity thing, right? Like you generally put the work in to find some deals and furnish your apartment nice and cheaply. If you're going to get another 10, 20, 30, 50 dollars a week on that in terms of enhancing your rental yield. Obviously, that's great for your real life cash flow, but obviously then you boost your borrowing capacity as well.
Yeah, there you go. There's a wealth of knowledge, and there's just so many different strategies or ideas. Joe, do you have any last-minute burning questions we need to ask before I ask people to jump on Spotify as well?
No. Mate, Rich, thank you so much for sharing your wisdom and knowledge. Actually, okay, I've got one more selfish one. Kind of towards the beginning of the call, you mentioned that you don't want to focus, like you want to focus on growth as being the core thing rather than caught up with cash flow. What are your thoughts in the current market right now, right? So we're looking at WA, golden child, right? Jeff and I were buying in WA. We were telling people, guys, 2022, buy. We're buying there. We bought a client $400,000. It's now revalued at $800,000. That was, and the yield was like 6%, stupid percent. So it was a clear, obvious winner, right? You now need to go buy in that same market. You now have to buy that property for $800,000. So the yield is like, I don't know, whatever it is, 4.5%. Now, Victoria, right? Victoria hasn't moved in many, many years, but the yield sucks. So, yeah, it's like, more than, 3-4 years. But if you, like, how do you think about cash flow and capital growth? A market that's already boomed and gone crazy, but has good solid yields, but is probably at the top of its market versus a market that's at the bottom, but has a lower yield.
Just checking you can hear me okay?
Yeah, fine.
Okay, cool. I've lost one of my earplugs. So for me, you got to look at the time horizon of what you want to hold that investment for, right? I mean, for me, it's still all growth based, right? So I'm never really looking at, okay, I can get a 3% yield in Melbourne or I can get a 5% yield in WA. The way that we were always looking at it was, okay, well, what's going to happen in Brisbane, or what's going to happen in Adelaide, or what's going to happen in Melbourne, and then go, well, we're going to buy these assets for 10, 20, 30, 40 years. What's going to happen in that time horizon, and then just buy based on what we think is going to happen based on the basic economic fundamentals, right? I mean, supply and demand, and the fact that, Sydney or Melbourne, their cities, Brisbane, they're not going anywhere in a hurry. Perth's different, right? And I've seen Perth over the years. I've seen Perth when it was almost as expensive as Sydney. I don't own anything in Perth. Because it doesn't really suit my more conservative way of looking at investing. And that's not to say that that's the right way to look at it either. But that's just the way that's the way that I've always invested. And it's always just based on like long-term sustainable growth, I suppose you could call it.
Yeah. Okay. So it's a longer term approach. The way I like to put this is like, get the highest growth you possibly can for the lowest yield that you can afford. Like if a 3% yield isn't possible, awesome. Then move to the market that has the 4% yield, but make sure that you've got that highest growth humanly possible. Rich, we're getting a whole lot of love here from this session. How can people get more rich into their life?
Can I just say, if you've gotten value from this session on how to build that $30 million property portfolio, because we're getting reviews on Spotify. We want to get this noise. Yeah. Of course. No, because jump on Spotify team, because I want to get this content and this message out to as many people as we can, because Richard is amazing. So Richard, please, how do people get more Richard in their life? Because you're going to get a whole bunch of inboxes for mentoring requests from the sounds of it. But yeah. If people want to learn about loans, where do they go?
Yeah, so in recent times, I've embraced trying to get out there and share more knowledge. So probably the best place to jump on for me at the moment is Instagram. Just launched a 30-day educational series where I drop a video every single day. Got 3 months of content coming online, and then I've also got a YouTube channel where I've shared the first video. I think it goes for about 28 minutes. In detail, sort of, where I started, the process I went through, the trials and tribulations, and a little bit more color on some of the specific deals in that story. My Instagram, I think, is just freedomfunding.com.au, and you can sort of find all the links from there.
I'm going to drop your YouTube channel in the comments. Sorry, I'm sort of delaying a very rich session indeed. So jump on. So I've just dropped Richard's YouTube channel in the comments. I hope that's the right Richard Morgan. I just typed in. That could be the wrong one. I think I'm going to have to change that. But oh, geez, that's a bit awkward. That's not you, Richard. But anyway,
to look that one up. It's that's okay.
freedomfunding.com.au/about. That is how you will get there, mate. I love it. I think that you've absolutely nailed it, and I mean the results speak for themselves. Like the key takeaway last session. It's funny. Last session we had the key takeaway that I got from our conversation was that you're not buying commercial property because you want to compound the value over time, right? You want it rather than having a commercial property that you own that's $2 million compounding at 6% return. Amazing. But you can go get a residential portfolio and you can compound over the next 20 years at 15, 20%. That's a far better annualized return. And I'm like, that's such a great way to think about it. From this session, the key points that I'm taking away are, why are you being so lazy on your portfolio? You've got cash. You need three things: cash, equity, cash and equity, borrowing ability and serviceability, and then cash flow to afford to hold the properties. And if you've got all three of those things ready to go, why have you got lazy equity there? Why haven't you pushed it? Just pick up the phone to the broker and make it happen. It's motivated me. So thank you for that. Wrap it up. Let's go buy a property, guys. See you later.
I found the right Richard Morgan on YouTube as well. I found it.
Oh, you did.
I love it.
Good.
See you next week, everybody. Thanks, Richard.
Thanks, guys. Appreciate it.
See you guys.
Cheers.